Picking stocks gets easier over time, but picking stocks and managing a portfolio are two very different things. Managing a portfolio is important and becomes crucially important as your portfolio grows. When I opened my first brokerage account at 18, I honestly didn't know what the heck I was doing, but I knew that I needed skin in the game to learn the ropes. Here's what happened with my 5-stock portfolio in the first year. 3 stocks traded around the same range. 1 stock got bought out, and the other stock was a high flyer. I got lucky that first year. The following years had their ups and downs, winners and losers. It wasn't until I had invested in the market for 10 years that I truly felt confident in my stock picking abilities. Still, today, not every stock I pick is a winner. That's impossible. What I've learned is that cutting my losses and reallocating that capital into winners will make up for those losses and then some over time. That's basic housekeeping now. But what's really important is how I structure and manage my portfolio. I believe I've set up my portfolio to best capture any and all opportunities in the stock market that I am aware about. I structure my portfolio into these 3 buckets. Number 1, mispriced large caps that still have growth. Number 2, speculative takeovers. And number 3, small and mid-cap capital compounders. Mispriced large caps that still have growth. Notice that I call these mispriced and not quote-unquote value stocks. The latter, value, I avoid like the plague, and some examples over time have included Sears, Blockbuster, and Nokia, among many others that are now in the stock market graveyard. With more experience, one can improve their ability to spot larger growth stocks that are nearing the maturity stage of their business life cycle, but that still have growth as they are making investments for the future. This challenging inflection point, from maturity to transformation and new highs, is an achievement that only some large companies will make in our generation and sets the mispriced stocks apart from the value stocks. For example, I started loading up on Starbucks stock in 2008 at around $15 per share when Starbucks was oversaturating themselves in the market and with most so-called experts doubting their strategy of selling high-priced coffee, especially with the financial crisis looming. Not only that, but there are new entrants in the coffee business, such as McDonald's. However, when I bought Starbucks stock after a big decline, minus 40%, I never witnessed a drop in traffic among the Starbucks locations near me. Starbucks had a clear competitive advantage. I thought if Starbucks goes out of business, that's probably when the world will end. Also, I pondered whether business people would ever switch their coffee meetings from Starbucks to McDonald's. Surely, they wouldn't be able to tolerate all those noisy kids. Both companies, McDonald's and Starbucks, are mutually exclusive, meaning they can coexist without eating into each other's profits, which most experts overlooked at the time. Starbucks founder Howard Schultz would also return to run the company, making new investments for future growth, which would send Starbucks stock surging upwards for years to come. Starbucks avoided a complete stall in its business and returned to its growth roots. Bill Ackman, an activist investor who buys stakes in companies to bring them back onto their growth trajectory, said in my book, Market Masters, "With most of our investments, we're investing in a great business that has perhaps gotten a bloated cost structure or that has not thought about its business correctly and maybe overinvested in parts of the business, or has not allocated capital correctly, or perhaps has lost focus and owns assets it should sell." End quote. I'm looking for those same mispriced large cap opportunities that still have growth as Bill Ackman. About a year after meeting Ackman, he acquired a sizable stake in Chipotle, which stumbled on news that most of its locations had served food with E. coli. The news sent Chipotle stock into freefall, and I believe it had lost around 40% of its value at one point from peak to trough. But Ackman understood the popularity of Chipotle. There's constantly lineups to buy both their burritos and burrito bowls in North America. Chipotle is certainly no Taco Bell, which is on a systemic decline across North America. Let's face it, Taco Bell food isn't good. Chipotle is now back on its growth track after that short-term misstep, and the stock has shot back up. An example of one of my more recent investments into a mispriced large cap that still has growth, of course, is Nintendo. Nintendo has long been a video gaming powerhouse. I'm still a big fan, and I'm 31 years old. Maybe I should finally grow up. But its stock lost 80% of its value from 2007 to 2015. The Nintendo Wii was a big hit, but then Nintendo seemed to fall out of favor from there. It started to look like Nintendo would share the same fate as Sega. But then in 2015, Nintendo's management made several key announcements with plans to unlock their intellectual property. Nintendo theme park, the Universal Studios, mobile games partnership with DNA, and talks of movies, virtual reality, and more merchandising. This was big news in 2015 because Nintendo's management had always been apprehensive to open its IP and venture into new markets. That's why I initiated my position in the stock in 2015. Nintendo has a treasure chest of valuable IP, which I would compare to Disney's. Let's see it continue to open up into new markets and venture around the world. I'm up about 100% on Nintendo since 2015. You can read more about Nintendo's intellectual property plans on their website, investor relations page. Speculative takeovers. As you now know, I invest in microcaps, sub 100 million market cap companies, which can also be considered speculative takeovers. Why? Over time, these microcaps will drop from my portfolio as they get taken over by larger companies for a premium price. Takeovers, or buyouts, whatever you want to call them, are especially prevalent in Canada, where small companies earn the scope of much larger and multinational American companies just across the border. These big companies are looking to expand their market share and get a bang for their US buck. But it's not just about microcaps. It's not just market caps that get taken over. I'm always staying on top of merger and acquisition activity, quote unquote consolidation, across the three core industries in my focus: consumer, technology, and diversified industries. Lately, it was the consolidation activity within the grocery and pharmacy market in Canada with Metro's acquisition of Chou, and before that, Loblaw's acquisition of Shoppers Drug Mart. It was a retail consolidation play to cross-sell through a shared customer base, pharmacy stores. In both cases, I owned and profited from the smaller companies that got gobbled up, Shoppers Drug Mart and Chou. Consolidation has also recently happened in the home hardware market. Lowe's, a big American competitor to industry leader Home Depot, made a bid for Canadian hardware company Rona to expand its presence in Canada. The deal fell through largely because of Quebec's intervention, and Rona's stock dropped from its high price that assumed the takeover would go through to a much lower level. After the drop, I initiated a position in Rona and just sat in the position. I speculated that Lowe's or another company, maybe Home Depot, would eventually scoop up Rona with both the Quebec government and shareholders' approval this time around. When Lowe's came back years later to bid on Rona a second time, they won approval to buy them out, sending Rona's stock up around 100% in one day on the basis of Lowe's juicy premium buyout offer, well worth the wait. The key to successfully investing in speculative takeovers, though, is to only initiate a position if you believe in the company and would hold your position even if the company doesn't get bought out. It should be a company that, like Shoppers Drug Mart, can generate high returns for you over the long run as an independent company, though it's definitely bittersweet when good companies get bought out by larger ones, as you must then find other equally good companies to replace the takeovers. Before moving on, here's a tip that I learned from my investment in Rona. While I bagged a nice return on Lowe's second buyout offer, Rona's stock dropped after the first attempt when news released that Lowe's offer was rejected. Usually when news is released that company A is buying company B will move up to right below the announced purchase price, leaving maybe a 5 to 10% spread, sometimes more, sometimes less. That spread will close once the acquisition is approved and the sale actually goes through. Thus, I'll sell company B before that time, taking my profits, just in case the sale doesn't go through. Small and mid-cap capital compounders. Last, but certainly not least, is the small to mid-cap capital compounders bucket in my portfolio. Why? Well, that should be obvious by now. These capital compounders are some of the best performing stocks in the stock market, growing at high rates of return on the foundation of their business models, managers' exceptional ability to allocate capital and operate the business, as well as execute on the company's vision. Stocks like Constellation Software, Savaria and Two Cows in Canada, and Rollins, Accenture, and National Beverages in the US, to name just a few. Here's the financial metrics that I analyze in these capital compounder stocks: high growth in revenue, high return on equity, and high return on capital. The ROE should be 20% or higher. The ROIC should be 10% or higher. Growth in free cash flow per share, growth in book value per share, and growth in earnings per share. I analyze these metrics in a company over a period of at least 5 years, as some companies can post a great record in 1 or 2 years, only to then fizzle out years later. That's why a combination of viable business model, non-cyclical industry, and durable competitive advantage is so important, because all these factors together determine a company's future. Numbers are just that, numbers, and don't mean anything in the long run, as they're all based in the past. I focus on the business, which is why my favorite sectors to invest in are consumer, technology, and diversified. Take a look at the screenshot below in the paperback and ebook, sourced from Morningstar.com, which shows key financials and profitability metrics for a company that clearly demonstrates outstanding capital compounders characteristics over time. But most importantly, it's a company that's built on a strong business model with an incredibly capable capital allocator and operator at its helm. I'll keep this company a mystery in this example, as it's not about the company, but rather the characteristics that you should seek out in other companies. There's only a handful of money managers who focus their investing mandate on small and mid-cap capital compounders. Francis Rochon is one of them. Rochon is the founder of Giverny Capital, and I like to call him the compounding machine. I strongly encourage you to read a couple of his investment letters that you can easily find online. If you enjoy the first 3 letters, read them all. Rochon's story is definitely inspiring. It's similar to famed investor Francis Chou's story, as his hedge fund started out as a small investment club with just family and friends' money. Rochon's Giverny Capital was officially established in 1998. It's located in Montreal, Quebec, and it has $500 million plus in assets under management. Rochon's investment philosophy is centered on owning outstanding companies for the long term, which means that Francois selects and invests in capital compounders just like me. See a list of Giverny's latest 13F holdings on Whale Wisdom to learn more about the individual stocks that he currently owns. The Rochon Global Portfolio has achieved a 15.9% compound annual return since inception, clearly beating the market. That means $100,000 invested in 1993 with Rochon would have compounded into over $3.18 million by the end of 2016, and even more since then. Yes, Francis is a compounding machine. Here are Francois' key points on successful investing that he included in the Giverny Capital Annual Letter 2016. We believe that over the long run, stocks are the best class of investments. It is futile to predict when it will be the best time to begin buying or selling stocks. A stock return will eventually echo the increase in per share intrinsic value of the underlying company, usually linked to the return on equity. We choose companies that have high and sustainable margins and high returns on equity, good long-term prospects, and are managed by brilliant, honest, dedicated, and altruistic people. Once a company has been selected for its exceptional qualities, a realistic valuation of its intrinsic value has to be approximately assessed. The stock market is dominated by participants that perceive stocks as casino chips. With that knowledge, we can then sometimes buy great businesses well below their intrinsic values. There can be quite some time before the market recognizes the true value of our companies, but if we're right on the business, we'll eventually be right on the stock." End quote. Now you know that I segment my portfolio into 3 buckets with average percent allocations as followed: mispriced large caps that still have growth, 10% allocation; speculative takeovers, 10% allocation; and my favorite, small and mid-cap capital compounders, 80% allocation. These 3 buckets deliver outperformance for my portfolio, a 15% compound annual return. This is what growth investing is all about: allocating capital to the best opportunities and beating the market over the long run.